money now so people can give you a payday advance, which is not a loan, and give and take a certain percentage of your future earnings. Push a button here today and get funded tomorrow. There's not a lot of understanding of what they're getting into and what the downside risks of them are. Notices from MCAs are an abuse of the Uniform Commercial Code, but they work. And so it is easy to target construction-based businesses. I mean, it's quite obvious that if you're the fourth MCA lending, that when you make that loan, that person can't pay you. That person or business can't pay you back. And the same thing can happen again and again and again. And all you want to be is not the last MCA there. Created a broker environment that enticed fraud and abuse. The easy answer is not the answer. Pushing the button to get a high interest loan to not have to face the problem is not the answer.
Welcome everyone to the first episode of the new rebranding of our podcast called the Mobilization Mindset. I am Scott Peper, founder and CEO of Mobilization Funding, and today we're going to be talking all about merchant cash advances, how they're detrimental to construction businesses, what your options are when you get in those painful moments in the middle of a week and you don't have payroll. What are your options? What can you do? I brought on an excellent guest, Adam Duso. He is the CEO of Second Wind Consultants, and he is going to walk us through not only the information you need to know, but what your options are, what a Title IX sale is, how you can access his information and others, and some of the best ways to navigate through what we all know are very tough waters. Adam, welcome to the show.
Thanks, Scott. Pleasure to be here.
So, merchant cash advances, how did you become passionate about them yourself? And to the point where you guys have written a lot about them. You're what I would consider and widely known as one of the best experts in the industry on what they are, how to overcome them, what they're good for, what they're bad for. And look, we'll be fair too. They're definitely good for certain businesses. They're just really bad for some.
Yeah, so I've been doing this for a little over 16 years, and I started doing this with the founder of the company, and we were primarily focused on doing SBA debt workouts and reorganizations. So for a number of years, we were just dealing with banks and other traditional lenders, and then all of a sudden, 2010, 2011, I saw my first MCA, and I was shocked to see the financial product in and of itself, but then it was amazing to just see it grow. And the way we do what we do at Second Wind Consultants is we work with senior secured creditors, typically to help reorganize businesses and honor the first position credit that was already there. The MCAs came in and started disrupting the order of priority by using certain tactics to go after collateral that they technically aren't senior on. So in that created an institutional problem, and we've been solving it ever since then, which has taken several different iterations. And I appreciate all the nice things you said about us and our organization, but we like to stay on the forefront of what is an ever-changing environment in the MCA space.
Yeah. So let's start with what are MCAs and how do they differ from other loan products in general?
Well, first is that they're not a loan. Merchant cash advance is a purchase of future revenue, whether that's receivables, regular traditional revenue receipts. So the MCAs are giving an advance of cash for a percentage of future revenue with a payback of a factor rate that can go into any number that they can create. There's no limits upon it because it is not a loan. It's not a regulated product. So it's much like a payday advance. Your payday is coming in 2 weeks. You need money now so people can give you a payday advance, which is not a loan, and take a certain percentage of your future earnings. And while that can fit in certain circumstances, it is where it has really become dangerous is it's become kind of the main street source of capital for many smaller businesses. And, there is needs for small bridge capital. It happens, especially if you're in a milestone business or you're signing a first large contract. Bridge capital is always necessary, but it's different when you have a bridge to a certain financial output versus just trying to make payroll on very, very expensive money.
Yeah. Why do you think MCAs so commonly derail these small to mid-sized businesses? And what are the dangers that these business owners are putting themselves in that they're just not aware of until it's too late?
Well, because MCAs are often lending in a subordinate position to other creditors, when their loans or advances go into default, the only way the industry is proven to collect anything is to be the most aggressive party. So that means sweeping bank accounts, trying to intercept receivables, doing things that can bring a business to its knees, because at that moment, their lien filing, if they have one, might be so far down the debt stack that if they don't act aggressively, they'll get paid nothing. So whereas a bank has a incentive to work with their debtors to try to work through things, as soon as things go bad with MCAs, they don't have that incentive. They have the incentive to be as disruptive as possible, as quickly as possible. And I don't think most borrowers understand that. I don't think they understand that a lot of these aren't loans, they're advances. I don't think they understand the cost of capital. There's a lot that, because it's all done so quickly, push a button here today and get funded tomorrow. There's not a lot of understanding of what they're getting into and what the downside risks of them are.
So, do you have any stories that you could share of construction businesses, subcontractors, or small to mid-sized manufacturing businesses, for example, that just otherwise running a healthy business, needed something, reached out for bridge capital, maybe found a merchant cash advance, and just kind of give a story of maybe like that fits a generality of what you've seen traditionally with these merchant cash advances in businesses?
Sure, I'll tell you one that we are just closing on now. We had a business contractor that was working in electrical contracting. And he was doing a lot of residential work. And as you know, there can be limitations in the residential space to getting access to capital. So for over a period of time, he decided to pivot and try to work more into the commercial space, which required access to different employees, different equipment, different upfront costs. And in order to support that pivot, he took on one MCA, and then it took longer than he anticipated to get the job, so he needed. So then he took on another MCA to cover the payoff of the first MCA and provide a little bit more working capital. And then by the time those jobs started paying, the MCAs were eating up all of the free cash flow. So he took another one to be, and by that point he had three MCAs, and it was already out of control. We were able to work with their first position creditor, and the business was reorganized, and the MCA liens were stripped off the business, and it survived, but it came this close to losing major contracts and not being able to perform, which if you're in the construction space, you know how slippery of a slope that can be.
Absolutely. Now, when you say reorganize, do you mean like in a bankruptcy or do you mean in a different method?
We use Article 9 of the Uniform Commercial Code, which is an extrajudicial process. It's an out-of-court reorganization. We are not attorneys. We don't do bankruptcy. Businesses can be reorganized in bankruptcy, but that typically works better with larger businesses than it does smaller businesses. Article 9 is a good fit for out-of-court bankruptcy or out-of-court proceedings that effectively do the same thing, which is reorganize the business into a new operating entity. And that's what we do with first senior position creditors in order to strip off the subordinate debt and allow the company to move over so that the jobs, the business, the value of the business is preserved without creating any damages to any of the creditors.
I love it. So in an example like that, why do you think the merchant cash advances are so detrimental to a construction business? And why does it feel like, and I don't know if maybe you'd agree or not with this, but it feels like the brokers that are selling merchant cash advances or the merchant cash advance companies themselves are preying on construction businesses oftentimes.
Well, that has kind of developed over time. So any business that has accounts receivable that are very sensitive relationships are where MCAs like to be. Construction is one of those areas, whether it's a general contractor or general contractor to the clients. Those relationships are susceptible to notices from these MCAs. Now, we can talk about that in a minute, but these notices from MCAs are an abuse of the Uniform Commercial Code, but they work. And so it is easy to target construction-based businesses as an MCA lender because I know if I send out notices of non-payment to all of those debtors' customers, that will bring the business to its knees, and the debtor will do whatever he or she has to do to pay me. So in those areas, being able to pull that lever totally de-risks the situation for the MCA and gives them a stranglehold, even though they're not the senior lender and that's not really their collateral.
So it's interesting though, because in the MCA world, I've talked to several MCA, like either brokers or lenders over the last 12 years that we've been in business. And I agree with you. There was a day where I didn't see many businesses with merchant cash advances. And now there's a day where it's hard to see one without sometimes, more often than not. That said, I've also heard from these businesses that not the businesses, but the merchant cash advance brokers or businesses that the defaults rate in construction is astronomically higher than any other business. And despite them understanding that most of the revenue in a commercial subcontractor business or general contractor business, but especially a subcontractor business, is funds that are being paid to them that are tied to other sub suppliers or lien holders and not really truly operating income or revenue that they could be utilized for the purposes of the business that they're buying those receivables on. But yet, despite knowing all that, they're willing to put loans or merchant cash advances into these businesses at such a high rate when they know also that their businesses operate at a margin that's typically maybe 1/3 or a quarter of the amount they're actually charging them. So why do you think that is?
Well, I mean, some of it is a game of hot potato, right? So if you think back to the leverage that they have in those situations where you bring a business to its knees, is the way you get that business out of default is they take yet another MCA from somewhere else. And it is about accelerating your returns. So if someone borrows $100,000 and is going to pay back $150,000 over 6 months, at month 4, they default. I can freeze their revenue. And if I'm the MCA, and when they come back to me, I will point them to one of our affiliated partners who we trade back and forth paper. They'll issue a loan that takes me out. So I still got my 150 grand, but now I got it in 4 months instead of 6. And the effective rate of return is even higher than was on, because it's a factor rate. It's not an APR, so you don't get a discount for paying it off early. They got the benefit of it, and they made that happen, knowing when they did the projections that you were probably going to run out of money in month. And so that lender then comes in, and same thing, same arithmetic. It might be a 10-month loan this time. They're going to fail in month 7. Or you're going to probably have gotten all of your principal back anyway. And the same thing can happen again and again and again. And all you want to be is not the last MCA there.
That's terrible. And that's a strategy that you've seen being implemented by the merchant cash advance companies over the years? as
I
you
mean, I
try to
don't own an
unwind it?
MCA company, but I've been doing this a long time. I see a lot of volume. It's the only logic I can put behind it, Scott. Otherwise, it's just people throwing spaghetti against the wall and seeing what sticks. But
Yeah.
I mean, if I try to apply some logic to it and seeing the patterns that you see going over, I mean, it's quite obvious that if you're the fourth MCA lending, that when you make that loan, that person can't pay you. That person or business can't pay you back. Just based on how MCA is doing underwriting. So if you're the fourth one there, you know going in, it's going into default. So the model has to be there to support it, or no one would make that deal happen.
So true. So two things I heard you say there. So I've heard some companies that it looks a lot like an MCA, meaning like it has a weekly or a daily even payment, but they're called term loans.
Mhm.
And they might even like have some kind of amortization schedule, but most often they don't. It still looks like a factor rate of some kind. Are those any different if they call them a term loan?
Um, yes, but I mean, they're still high interest products that, with a high volume of payments which struggle the business's cash flow. So they are dangerous, but they are a loan. So when it comes to collections, they typically follow all of the rules and guidelines of a regulated financial product. They are unlikely to send notices to customers and try to jump the order of priority. They are likely to do things that most term loans or banks do in default. So that risk of what happens when it goes wrong is much more, uh, it's much more practical and understandable. The debtor knows their rights. If you pay off a term loan earlier, typically, if they're the right one, there is a discount because there's the implied amortization. So, like, there is some, they are a friendlier version. It's just like high interest credit cards. So you got to be careful with high interest debt and how much you take on. But I would much prefer a client have a high interest term loan than a merchant cash advance.
Agreed. So let's get to the broker world of this now. So you have the actual capital sources, um, which are few, I've learned actually. And you kind of insinuated that when you said they go to one of their sister companies or sister lenders, but yet there seems to be 100x or 2000x actually the amount of brokers selling the same lending products, but under like white labeled terms. So is this the broker network problem or is this the lending company's problem? Who's the problem here and or both?
I think it starts with the lenders. They created a broker environment that enticed fraud and abuse. So anyone can be a broker of MCA products. You can sign up with most of them online and start sending over deals the same day. There's no background checks. There's no history in finance. There's no holding a broker's license. There's nothing. So if it's that low of a barrier to entry and you pay extremely high commissions, then you incentivize an unregulated market to just throw as much of that is out there as is possible. And so there's a lot of problems in the broker market of brokers misrepresenting the product, overselling it, straight up fraud and underwrite. I mean, there's a lot of issues at the broker level, but it appears from my seat that the MCA set up this broker network as a way to kind of offload that liability to third parties and just pay high commissions. And with the high commissions, if I'm a broker that can sell an SBA loan for $150,000 and have it make me 1 point in referral commissions, or I can sell $150,000 MCA and make 10 points in commissions, there's a disincentive, right? Like, so I don't care if anything matches up, that I have a 10x return on selling this MCA product, whether or not the customer can actually afford it.
All right. Shot. That's unbelievable. So you think the average commission could be as much as 10% or even more?
even more. The crazy part, and where there are certain ISO or sales relationships where an MCA will come with the initial term sheet to the broker first and say, we're willing to do this at a factor rate of 1.28. You're going to get 5% on that. If you want to increase the factor rate, you get to increase your commission. So if you bring it up to a 1.35 instead of a 1.25 factor rate, then your commission goes from 5% to 10%. So now they're incentivizing them to sell a higher interest debt product to the end customer in order to increase their return on originating that loan.
So let's go back to the businesses now. So we'll back to the business owner. And you made a good point. And this is where we see it too. You're in a tight week, just like the example you gave. You need to make payroll. Maybe you held on to some payroll too long. Maybe you didn't keep people. You couldn't move to another project. Project got delayed. There could be many good reasons why you're in a short-term need for cash. And what are your suggestions to those business owners when they have that problem? They're in the middle of living it, and they got to go pick up the phone, and bam, there's the merchant cash advance broker willing to solve that immediate problem. What do you suggest they do instead in that moment, or before or after?
My father used to tell me everything worth doing is likely difficult, right? So the easy answer is not the answer. Pushing the button to get a high interest loan to not have to face the problem is not the answer. If you are working already with a factoring company or a purchase order to factoring relationship, working with those senior lenders to organize an over advance temporarily to get you from here to there, if it's viable, those lenders actually know your cash flow. They actually understand the likelihood of repayment. You will collectively make a responsible financial decision instead of the instant gratification of pushing a button and having the short-term problem go away. And it's just a slippery slope. But so I look to the first position senior secureds to help solve these problems when they are in the position to do that. An MCA, look, if you're about to take on a new client or a new contract, it's the biggest one you've ever taken on. It has upfront costs of $250,000 that are not built into your model, but it will cash flow within the next 90 days. MCA is great for that. It's a great product, right? Because that contract will live on. You're giving up some of the short-term benefit in order to have some of the long-term benefit of the business. It's a great fit for an MCA. Doing it to make payroll is not a good idea.
Yeah. Now, in that example you gave, if you can guarantee that that's going to happen within 90 days, it'll work. But if it doesn't, you now are in really a cash flow strain right from the beginning because those weekly payments start right away. So even over a 90-day period, you could have paid back almost 50% of that loan in some cases, right?
Right. And again, that would be my other suggestion is making sure that you're borrowing the amount that you understand the cash flow, how much you're borrowing, how much is going to come right back out in debt service, and does that leave you with the net that you need? Because if the answer is no, then you're taking a step backwards, not a step forward.
Yeah.
But if you borrow the full amount of the debt that you need to get through a bridge, look, there's bridge financing has been part of the world forever. It's like part of the original financing that we as human beings came up with was short-term bridge financing. So there will always be a need for it, but the second you become dependent on it, you're insolvent.
Yeah. The one thing I like to bring up to folks in that situation, because I do agree with you, I think that's a great use of it. However, if you determine that that's your cash flow and that's how much money you need, and you've done that as your gut feeling, and you don't have a real cash flow map built out, your accountant and your advisors haven't been consulted to see exactly what you need. You don't have your bid template married up to your schedule of values, married up to your work schedule. You've worked with the client before and you have way more than reasonable expectation that they are going to pay you on time. The owner is there. Everything's working smooth. You're not in a rainy season and all the other things that could go on. And you've
Mhm.
really detailed it out and you have some room and cushion in there and you make that decision then, I support it 100%. But absent that type of thought or those type of materials or visibility into your numbers, and if someone's listening to this, they're like, well, I don't have visibility to those numbers. How am I supposed to do that? The answer is should be no every time because you should have visibility in your numbers like that. And that's the way to make those types of decisions. Now, what I can also tell you, and Adam, I'm curious if you agree, and this is where my question is, businesses that have that type of visibility into their numbers and have those type of reports and those types of systems and support, do you often see them more likely to take merchant cash advances or less likely?
Less likely, but it still happens a lot. And there are a lot of reasons why that is. And a lot of it is that the smaller and the lower end of the middle market, there's a lot of and it's a really good thing, but there is a lot of SBA debt. There's still a lot of EIDL debt. There are a lot of lingering blanket UCCs across many of these small operating companies, and especially in a world of construction, no one wants to lend in a third position other than an MCA. So you could have a great business, a first position SBA loan that you are current on, you have no problem paying. You took a second position EIDL to get through COVID. You have a very healthy company. You don't qualify for finance.
Correct. Explain why, though. I agree with you and I understand. But for the audience listening, why don't they qualify for financing?
Because you don't have the assets to back it, right? Your SBA loan is already most likely more than the value of your assets. Because if it wasn't, then it wouldn't need to be an SBA loan. You would have gotten a traditional loan. An SBA is a guarantee that backs a loan because there's insufficient collateral. So just like an FHA backs a house loan, if you don't have a significant enough down payment, it's the same thing. It's a subsidized product for businesses if you don't have enough assets. So if you have an SBA in first position, you already don't have enough assets to pay off that SBA loan in full if on the business side of things. If then you took a second SBA loan to get through COVID, that has a second position blanket lien on all of your assets. And you certainly don't have the asset coverage ratio to get both of those paid so that the next person you want to borrow from is secured. And there is a hole in this market for access to capital because it's largely unsecured. And in the unsecured market, there's high interest term loans, at least for smaller businesses. When you get larger, you have, mezzanine deals and private equity deals and things that are not available to the lower middle market. But in the lower middle market, you have high interest term loans. You can leverage your personal assets to get like a HELOC and put your home equity into the business. Or you have MCAs. There's not that many options available. So because there are businesses that have their numbers that look at these things and they're less likely to take them if they're terminal and there's no way to repay them. But if they can map out an opportunity to be able to support the debt and there are no other possible options for capital out there for them, they are likely to take it, even if they're not accompanying for all the risks, the rain, all of the things that could delay the ultimate
Yeah.
output, because there is a reasonable projection that shows a path of being able to be repaid. And then you don't make that path and one leads to two, right? And then that's when you become dependent on short-term capital for long-term needs, and it's a problem.
Yeah, no, I see and agree with you so often. And getting ahead of it, properly setting up your business, which I know is part of what you guys do as you transition out of the one entity and into the title through the other side of the Title IX sale. Setting up your business properly, proper accounting, proper legal work, proper financials and balance sheets and income statements and the organization of your debt structure and all of that classification so that you can then operate properly and get not only new debt, but the right debt and be ahead of that game. That's a lot of what is part of the process also. It's not just cleansing the MCA debt. It's really putting yourself into a reorganization, yes, but a reorganization of a lot of aspects of business. Is that fair?
It is fair. We do say no repeat customers. So we like to reorganize the business and send it on its way with best practices in mind. I'd also like to add to the list of things, especially in construction, job costing. Job costing. Setting up that best practice is like the guiding light. If you know what you make on every job and what the costs are and what the marginal costs and therefore what your margin of error is, you'll be able to charge more efficiently, collect more efficiently, manage your cash flow more efficiently. So yes, we like to set all of these things up. And I like to say in the construction space, the way to survival is to grow to the point where you can get a good CFO. Because when you become a small business, you don't have that ability. And if you can survival of the fittest your way to a level of revenue where you can support a CFO, then you have a real chance of success if you let that person actually be your financial counterpart.
I couldn't agree more. I could not agree more. It's a great simple way to look at where you've achieved it. Now, of course, you have to have the right CFO, and if you're in a
Yes.
construction business, please hire one with construction experience. Just a CPA that graduated school that happens to be a family member is not a CFO.
No.
But find a CFO that has real experience, or access to one is a great tool of advice. So I want to ask you, what are 406 notices, and why are they such a disruptive tool for the MCA companies?
406 is a provision under Article 9 of the Uniform Commercial Code, and it is written for factors and other secured financiers who purchase receivables as part of their agreement. So what it is meant, let's assume you have a factoring arrangement. A factor buys your receivables, and then your customers are supposed to pay the factor directly. If you were to instruct your customers to pay you directly, the 406 notice is sent out to the customers to let them know that they have a legal responsibility to, in fact, pay the factor instead of you, the service provider. That is what the 406 is meant for. Because MCAs say they are purchasing a percentage of your future receivables, they are using the same logic to send those notices to all of the AR or outstanding customers who may have invoices and trying to redirect all revenue to them, even though they might be the fifth UCC holding. And therefore, by doing that, they're not only bringing the business to its knees, they're not only damaging long-term customer relationships, they're not only messing up potential bond issues and other things that are entangled with non-performance. All of those things that they're creating, they're also damaging the collateral of first position senior creditors. Because if I was a factor and an MCA intercept receivables, they're actually stopping the factor from being paid by trying to intercept the receivable directly. So 406s are a problem. They're a problem. It's an abuse of the process. Right now, MCAs say they have no obligation to see whether or not they're in first position. They can send out the notices and it's not their responsibility. I know that there are some attorneys general looking into this, and I think the day of that naivety is probably near an end. But for now, it is a problem. And if you have an MCA creditor and you are facing default, and they know who your customers are, which they can probably figure out from looking in your bank account, they will send notices. It's not an if, it's a when. So some of them it's immediate, some of them it's a couple weeks after default, but it will happen.
Do you find that they have any liability, or they've been found to have liability if you have a factor or another secured lender that actually ends up pursuing them?
I know that the few times that factors or first position lenders threaten suit, in most cases, MCAs back down. I have not actually seen it go in front of a judge. And it's because it's very simple. The Uniform Commercial Code is very simple. It's first to file. So if your UCC has a date on it that precedes the other person's UCC, there's not a whole lot to talk about, right? So I don't think, the these guys will push it as far as they possibly can, but I don't think they can survive. I don't think a single one of them can survive to scope.
With the 406 notices and the fact that they're using these so much to gain control of that, income stream for the business, isn't there liability from the senior secured lenders? And are they in instances, have you seen them pursuing the MCA companies for liability?
Uh, so whether or not there's liability, there's certainly perceived liability. The UCC is pretty clear. It's a first to file system. So if your UCC precedes someone else's UCC, from a filing standpoint, and there's no intercreditor agreement, it just is what it is. So, there is certainly perceived liability of them damaging senior secured lenders' collateral. In my experience, when lenders either threaten to litigate or send cease and desist notices or really step in to protect their collateral, the MCAs will rescind those notices and honor the Uniform Commercial Code at that point in time. I have never seen it go in front of a judge because I don't think it would go very well. I don't think there's a fact pattern where that would fall in their favor. If there's a first position senior lender that says my UCC is superior to yours, please cease and desist your collection actions. It's unjust enrichment, tortious interference. I mean, there's all sorts of different claims that could be lobbied against them. And I don't think the MCAs are in a legal environment where they really want those to go to challenge. There may be cases that I'm unaware of where, legal liability has either been litigated all the way through or not, but none that I'm aware of.
Yeah. I mean, at a minimum, it certainly feels like tortious interference. But to your point, if you don't ever get to the judge, or by the time you do, the damage is already done. So the point is, like, once you're in this bucket, getting to a place where you can stop the pain is exactly the best course of action to take. And that's only going to happen from not ever doing it or getting yourself organized to begin with. I do like what you said, though, about working with your current lenders. And it goes to a phrase I like to say a lot of times is when in trouble, you got to pick somebody to trust. You can't not trust anyone, and you can't fight everyone. And if you have a senior secured lender, they've probably earned the right to be able to work with them. Or if you have another lender that is willing to work with you and communicate with your senior lender and all work in a normal environment for the benefit of helping the business survive and move forward, like you have to make that choice to bond and attach to somebody, right? And communicate and be open and be honest and work with them and let them work with you. And it's definitely not going to be by taking another merchant cash advance.
No, it's not. And look, first position lenders are a mix as well. There are a lot of good actors in the first position lending space, but there are a few that are difficult to work with. It should certainly be any debtor's first stop to work with them. And if you can zoom out of the emotional decision that you're in, you can see who has the most to lose other than the business owners themselves. It's typically your senior secured lender that has lent the most into the business and has, it's going to be the most that you're in the same boat with them. Yeah. Right? Just because they are your lender, you guys have to figure this out together, and they have an incentive to work with you. So it won't always work. I wish it would, but that should be anyone's first stop, is to see if you can work with the people who already have a vested interest in your success instead of your failure.
Adam, tell me, we've talked about a lot of aspects here to the merchant cash advance world. A lot of people listening to this are familiar with it, but they just might not know what to do or what other alternatives are there. Of course, people watching this know about mobilization funding and our ability to lend. Sometimes we're a senior secured lender, but oftentimes and most often we're not a senior secured lender. But what other options out there do you suggest people to do in that moment of pain that they can pursue to move forward and find solutions inside their business without trying to find extra cash? Have you coached or counseled people through that prior?
Well, yes. I mean, it depends on where they are in the process. If there's still time for a financial turnaround, I would say most people in the construction space, the best practice is job costing. It is that like your margins are not correct, which is resulting in you bridging gaps that are, you know what I mean? So like the best thing is making sure that you get each job profitable and that you're holding the standard net margin and you're building in some padding for risk, and getting the job is not better than making profit,
Yeah.
right? So that understanding those base metrics, if you have run room, those are the things that, you know, sometimes working with the right turnaround folks or a seasoned construction specialist will help you kind of navigate into operational best practices. Um, that also probably includes, you know, managing subcontracting costs, keeping your labor at the right point, all of the key metrics that you would need to do to run a profitable company. If it's at the point where MCAs have stressed the business and you realize that whether or not it was by design, you're now dependent on short-term financing for your long-term operations, um, there are only a few options, fortunately. You can get with the right alternative lending partner for which that should not be an MCA. Maybe it's a mobilization funding. There are some other creative funds that like try to create stretch pieces. And maybe if you're not too far gone with MCAs, those guys can help refinance those debts or help you out of those situations without you having to go through a reorganization. If it's beyond that point, then smaller businesses should seriously consider an Article 9 reorganization in line with getting into best operating practices in order to make sure that the short-term action of MCAs does not hinder the operations from its turnaround. It may make sense in certain cases to also consider a sub-Chapter 5 under bankruptcy, depending on the amount of debt the debtor has. A true Chapter 11 is very difficult unless the company is of a substantial size. It's just too costly, and the amount of contentious proceedings are just too long. And getting dip financing at the lower end of the middle market is near impossible. So for all those reasons, a Chapter 11 typically is not a good fit, but the sub Chapter 5 can be a good fit. Article 9, we do a lot, especially if you have a senior secured lender who is a reasonable organization that is willing to work with the organization. And Article 9 is a very quick and cheap process that will allow you to reorganize your balance sheet. There are also some other options in certain states. An assignment for the benefit of creditors, also known as an ABC, is something that could offer a similar output to an Article 9.
So are there any questions about MCAs that I should have asked you and did not, that you want people to make sure they know?
Sure. There is most recent trend that we have been facing is if you've been following the MCA space, the state of New York has been cracking down on MCAs. There was a large suit against Yellowstone and their tree of family MCAs that was in the billions of dollars in penalties, and they're no longer able to operate in the state of New York. Same thing happened in New Jersey, and other states are cracking down on these types of institutions. There are, however, 50 states, and we have already seen the abuse of the prejudgment remedy in Connecticut. So if someone has an MCA that is originated out of Connecticut, as soon as an MCA files a lawsuit, they haven't even received the judgment yet, they can immediately go to the court and ask that they freeze your bank accounts while they wait for the judgment hearing, which brings a business to its knees within a day or two of default. It can be a day or two afterwards and your operating account is frozen. So that is Connecticut, and its regulatory boards are actually on it. That won't survive till the end of the year, but there is some regulatory process that has to happen. So knowing this industry, they'll go full throttle at using that until they can no longer use it anymore. So good news is help is on the way. But it might take till the end of the year to get here and be challenged legally and be a banned practice. But between here and there, if you have an MCA and you're facing potential default in the near future due to cash flow issues, I would check the state of origin, and I would, if it's Connecticut, you have reason to be very concerned about the status of your bank account.
I love it. That's painful. That is painful. That reminds me of the New York statute where you could just get a judgment right away within 2 days and then use the judgment itself.
Yep. Yeah.
Thankfully,
That's
that's
those
gone.
days are gone, yeah, those days were gone. And so this is regulation is coming. It's just going to be slow and painful, and there's going to be a lot of collateral damage along the way.
Ugh. Well, Adam, how can people find you, find Second Wind Consultants, and best see and access your tools and information and content, but also your services?
Yeah, you can get everything you need at secondwindconsultants.com. That's our website. We also have, a social media presence. And we have a large network of people within the secured lending space. So you may get referred to us even if you reach out and try to go get capital somewhere else. So through any one of those channels, we'll take people where they come. We know it's a difficult situation to be in, and we offer a free consultation. It's confidential. And if it just gives you the peace of mind of understanding what your options are, sometimes that alone can be of benefit.
Love it. Well, everyone, I hope you have found this information from Adam as valuable as I have. I hope you reconsider the pain points when you're in the middle of them and think through all of your options and the best places and options and ways to go get that information and the tools you have available to you, other than just relying on the quick fix MCA. I think we could all gain some wisdom from Adam's dad and his messaging on typically the easy fix is not the best. Find the best value in the things that are hard. I think that's great advice and counsel. And until next time, I wish you all a great week and may God bless you. Find both Adam and I on LinkedIn, on our websites, and of course, you can find Mobilization Funding on its YouTube channel and our website as well. Adam, thank you very much. I appreciate you coming on the show.
Thanks again, Scott.
You're welcome.